Welcome everybody to another video, and I hope you guys enjoyed this one because this one took a very long time to create. In this video, you're going to be able to learn about 8 different companies that are emerging stronger and bigger and more versatile than they were before the market dipped at the beginning of 2020. So let's go ahead and take a look at the first 3 companies. I want to make this video between 10 to 15 minutes. That is why the first company and its competitors are going to be evaluated a little bit more detailed than the other companies in this video. We're going to take a look at Alibaba, Amazon, and eBay evaluations. And before we jump into the computer to show you the information that I found the most valuable, I wanted us to discuss the idea that there's a difference between each one of the companies that I just mentioned. Obviously, the main difference between Amazon and the other 2 companies is that there are warehouses where a majority of the products are stored, and then Amazon themselves, through Amazon FBA, fulfills their orders of the customers. In the meantime, on eBay, you have customers buying products from personal vendors and personal resellers all across the world. At the same time, we have Alibaba that connects vendors with buyers, and they act as a middleman, having vendors pay a portion of their profits for the use of their platform. During these unprecedented times, I noticed one thing that is considered to be a downfall of Amazon. I was trying to purchase something online, and then when I found that item, I was trying to buy it, but the waiting time, even with Amazon Prime, was about 3 weeks. So I made a conscious decision to go to eBay and see what the delivery time would be on eBay. And due to the fact that that item is not necessarily stored and fulfilled by one company, which is Amazon, and it's stored at their warehouses, it was actually stored at somebody else's house, right? At their own garage or at their own apartment or at their own warehouse. And those people on eBay would be able to actually fulfill the order and get the delivery down to 3 to 4 business days. With this being said, during these unprecedented times, it is interesting to keep in mind that the delivery time on eBay is actually shorter than on Amazon. Let's go ahead and start off by a 1-year technical analysis of Amazon. In front of you, you can actually see that the Amazon is currently trading at about $2,380, so about $2,400. And it seems like it's on the pattern of the reversal. RSI and MACD indicator shows us that it is currently at the overbought price. It wouldn't be 100% possible to predict where the price is going to go right now, especially with such uncertainty and high volatility on the markets. But every single time we saw the MACD and RSI indicator to show us that the price is overbought, it ended up dropping down to the consolidation price to its previous support line, which is around $1,700. And then after a short consolidation, it would have a pop and it would make double tops. It would drop down, then it would make double bottoms, and then it would start going up again. Amazon's PE ratio is currently 103.41. Unfortunately, this company doesn't pay any dividends, but its growth actually substitutes its dividends in comparison to other companies within the same niche. Right now, we are looking at a 1-year chart of eBay. And as you can tell, it recovered majority of the profits that was lost at the beginning of 2020. The company dropped 31.6% to its lowest price of $26.16, and it was able to push back, gaining 46% back all the way up until $38.44. Currently, the PE ratio for eBay is 18.33, which is about 20 times less than the previous company. And on top of that, they also pay 1.7% in dividends. And the last out of 3 companies that we're looking at right now is going to be Alibaba. As we can tell, it made double bottom here at the consolidation price of $170. It's been trading at that price level for quite a long time up until it started breaking out. Making new highs of about $231.14, it dropped way to $171, which was able to recover majority of their losses back to $213.49. Alibaba's PE ratio is 60.29 with no dividends. An interesting fact about Alibaba is that they're planning on having a stock split, which you're going to receive 8 shares for every share that you own. To conclude the evaluation of these 3 companies, I would like to say that long term, I think Alibaba is going to be the best investment to make, not due to the fact that they're going to have a stock split where they're going to give you 8 shares for each one that you own, but for their business model. They connect vendors with customers, which I think is a great idea to go about it in the emerging markets. Okay, I promise that the discussion about last 7 companies are going to go much faster. We're not going to be looking into the intrinsic value of each one of the companies. We're just going to go ahead and jump directly into the conclusion about those companies. Company number 2 is going to be Waste Management. Waste Management was founded back in 1968, and the company provides integrated waste management services consisting of collecting, landfill transfer, waste-to-energy and in-plant services, recycling, and other related services. Unlike the other 3 companies that we just talked about, Waste Management hasn't actually recovered fully from its losses. The highest price that it was trading at was $126.79 when it dropped all the way down to $86. So that's about 40% loss. After that, it was able to recover and consolidate around $98 a share, and it was able to regain 14% of its losses. Waste Management has a PE ratio of 25.29. It currently pays 2.25% in dividends. Company number 3 is going to be Disney. Some of the products of Walt Disney Studio Corporation actually include television, publishing, films, music, video, games, etc. And its revenue, it's trading at about $69.5 billion back in 2019. Disney has taken over certain markets that they have not been at before, which means that they are becoming a lot more versatile with their broadcasting platform. The company is currently trading at about $101 per share, with its lowest price being at $79.07. It actually lost a little bit more than 50% of its previous value, and the company was able to recover approximately 25% of its losses from its previous lowest price. P/E ratio for Disney is about 17.08, and forward dividend percentage that they yield is 1.75%. Company number 4 is going to be American Waterworks. American Waterworks is an American public utility company operating in the United States and Canada. It was founded back in 1886 as the American Waterworks, and the company actually provides military services groups. It works with the United States military to treat and supply water and to collect and treat wastewater for military installations all over the country. To date, American Waterworks Military Services Group provided services to approximately 11 military bases. Right now we are looking at American Waterworks with the highest price of $141.70 per share. It went down all the way to $92 a share, which is still not too bad of a price to pay for the company, and it was successfully able to recover approximately 45% of its losses back in February of 2020. Currently, we are looking at 1-year chart of American Waterworks with the highest price of $141.70. It went down all the way to $92 a share in March, and it was able to successfully recover approximately 40% of its lost value. Currently, the P/E ratio for American Waterworks is 37.58, and it currently pays 1.59% in dividends. With this being said, the company seems to be rated as being overvalued, but if you look at the chart that starts back in 2008, we can see that the company was able to recover from the financial crisis of 2008, and it was constantly growing up until now, when it started consolidating at around $121 and $122. Company number 5 on our list is going to be General Dynamics Corporation. So what is General Dynamics? General Dynamics is a global aerospace and defense company, from Gulfstream business jets and combat vehicles to nuclear-powered submarines and communication systems. So people around the world depend on the products of General Dynamics. Their products include business jets, combat vehicles, tanks, fighter jets, weapon systems, munition watercraft, submarines, and communication systems. Their revenue was reported to be at $36.19 billion, with operating income of only $4.45 billion. Again, those numbers are coming from 2018. They have not been updated to 2019 just yet. General Dynamics is currently trading at a price of $133 a share, and it's been consolidating during the normal economic times at about $182 a share. The company has not had a chance to fully recover from its losses. It was only able to recover approximately 33.91% from its lowest trading price within last year. So with this being said, I think this company actually offers a lot of potential for growth all the way up until its previous price of consolidation. It offers about 33% profit margin. Company number 6 is going to be British Petroleum. There's no need for me to remind you about 2010 oil spill. There's no need for me to remind you about the volatility on the markets or to smash that like button below, because that is obvious. In my understanding, the oil demand for the next 10 years is not going down to zero. In order to help us make the decision of how important this company is, we are going to go ahead and look at its technical analysis. Besides the obvious facts that we know about the British Petroleum, we know that the company actually owns 5 different companies besides that, and it also engages in a production of renewable energy. Besides just the oil and gas, it actually works on its wind farms that it owns. Before the huge volatility came into the markets and all the issues with the oil companies started happening, it was trading at about $38 a share. Right now, it dropped all the way down to $15 a share and was able to successfully recover approximately 50% from its previous lowest price. It's currently trading at about $23 a share. And to me, it does show a lot of potential for growth at about 50 to 60% of recovery to its previous consolidation price. When it comes down to British Petroleum, we can see that the PE ratio for the company is about 19.73, and the dividends that they pay have not been adjusted yet, but it's approximately 11.65%. I used to hold on to this company for about a year and a half, and the dividends that they were paying were approximately about 6.5% per year. Company number 7 is going to be Caterpillar. Caterpillar Corporation actually is in a Fortune 100 companies that designs, develops, engineers, manufactures, and sells machinery to the financial institutions, to the consumers via worldwide dealer network. Company's revenue for 2019 was about $53.8 billion. Caterpillar is also the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Caterpillar wasn't able to recover fully from the losses that it took. So it used to trade at approximately $150 a share, and then it dropped all the way to $87 a share. It was able to recover approximately 30% of its value, and seems like it's currently consolidating between $112. It seems like it's also hitting the previous resistance at about the same value that it took and double bottomed at basically the same price. So we might see some resistance here. PE ratio for Caterpillar is approximately 10.26. They also offer about 3.75% in dividends. And for my pick number 8, I'm actually going to choose an ETF that was founded back in 1976. It's a Vanguard ETF. VOO for a ticker symbol. This is where I keep majority of my money at, and we're going to go ahead and look at the charts and some of the data about that ETF here on my computer in a second. Vanguard S&P 500 is an ETF. It's not an index fund. It has a ticker symbol of VOO that invests into the stocks in the S&P 500 index, representing 500 of the largest United States companies. Right now we are looking at 1-year chart of VOO. With the highest price of $311 a share, it dipped down to $200 a share, and it was able to successfully recover approximately 26% from its lowest price. It is currently trading at $257 a share. It is currently yielding about 2.24% in dividends, and this is actually something that I have been investing into majority of my money into, because over the past 5 years, it has been consistently growing, and even when it had its ups and downs, it was able to successfully continue the upward trend. It might not be the case right now. We might potentially continue going down, but over the past couple of years, the percentages that they were paying actually paid off for some of the losses that I was able to take with a grain of salt over the past couple of months. Well, that's about it for the video. I hope you guys were able to find some value in this. And if you did, I'm sure that you have a lot of thoughts about what kind of companies you would want to invest into, which ones you would want to stay away from. If you do, don't hesitate to leave me a comment in the comment section below. I will also leave a link in the description below to our Facebook group, where we usually have a discussion about the companies that we swing trade, day trade, and just buy for a long term.